Students, today we are going to solve the second illustration. First I will read the question. Following is the balance sheet of the firm of Nana, Nani and Sona, who share profits and losses in the ratio of their capital. Balance sheet as on 31st March 2019. Liabilities, capital accounts, Nana, Nani and Sona. Creditors and bills payable. Assets, machinery, building, stock, debtors less RDD and cash. Sona retires from the business on 1st April 2019 and the following adjustments were agreed. Stock is to be valued at 92% of its book value. Now students, here you can understand that the value of stock has reduced by 8%. So whenever the value of asset decreases, the difference is recorded on the debit side of the revaluation account. Here they have asked us to prepare revaluation account, partners capital account and the new balance sheet. So here, as per the first adjustment, the value of stock has decreased by 8%. So the entry will go on the debit side of the revaluation account. Here the value of stock as per the old balance sheet is 12,000. So from that 8% you have to reduce. So here the entry is recorded on the debit side of the revaluation account to stock account 960. That is 8% of 12,000. Second adjustment, RDD is to be maintained at 10% on debtors. So you have to take 10% of this 12,000. The debtors are given in the old balance sheet 12,000. Then there is RDD 1,000. So 10% as per the second adjustment you have to take 10% of 12,000, that will be 1,200. Now here the old RDD is 1,000. If you subtract 1,200 instead of 1,000, the value of debtors will further increase by 200. Sorry, the value of debtors further decreased by 200. So when the value of asset decreases, it is recorded on the debit side of the revaluation account to RDD account 200. Then the next adjustment, the value of building is to be appreciated by 20%. Appreciated means increase in the value of asset. Value of building as per the old balance sheet is rupees 55,000. 20% of that is 11,000. So when the value of asset increases, it is recorded on the credit side of the revaluation account by building account 11,000. Then you have to check other adjustment also, whether there is any increase or decrease in the value of assets or liabilities. So we can see that only first three adjustments were regarding the difference in the value of assets. So we can close our revaluation account. Here we can see, after recording first two entries on the debit side and one entry on the credit side, we can see that the credit side total of the revaluation account is higher, that is 11,000. From this 11,000 you have to subtract these two amounts of stock and RDD. The balance remaining is 9,840. That is called the revaluation profit. It is to be divided among all the partners in their profit sharing ratio, which is given in the question. Here it is mentioned that they share profits and losses in the ratio of their capital. So the profit sharing ratio will be 5:2:3. So in that ratio, this revaluation profit is divided among three partners and then it is transferred to the partners capital account. Now we are going to make partners capital account. On credit side, you can see by balance brought down. This is the amount of capital given in the old balance sheet for all the three partners. Here you can see under liabilities they have given capital account for three partners. So this is the opening balance in partners capital account, which is to be written as by balance brought down 50,000, 20,000 and 30,000. Then the second entry is about the revaluation profit. Here it is calculated. So profit and loss adjustment account is nothing but the revaluation account. So the entry is recorded on the credit side. Now we are going to study further adjustments which are given in the question. Fourth adjustment is about the goodwill. The goodwill of the firm is fixed at rupees 12,000. So this is the goodwill for all the partners. 12,000 is the goodwill for all the three partners. What is given further? Sona's share in the same be adjusted in the accounts of continuing partners in gain ratio. Now from 12,000 first we have to find out Sona's share. Now here it is given that they share profit and losses in the ratio of capital. So the ratio is 5:2:3. So the share for Sona is 3 divided by 10. Total of 5 plus 2 plus 3. So Sona's share is 3 divided by 12. Now with this you have to calculate her share of goodwill, that comes to 3,600. So here it is written by goodwill account in Sona's column 3,600. They have further given that the goodwill is written off. So the entry will come on the debit side of the partner's capital account. Students, when I was explaining about goodwill, I had explained that whenever the goodwill or the share of goodwill of the retiring partners is written off, it is recorded in the gain ratio. So here the working is done for calculation of the gain ratio. The formula to calculate gain ratio is new ratio minus old ratio. Now the new ratio is given in the question. So here you can see in adjustment number 5 they have given the new profit sharing ratio is 3:1 for the continuing partners, that is for Nana and Nani. So here the new ratio is 3:1. Old ratio is in the ratio of capital 5:2:3. So first we will calculate Nana's gain ratio. New ratio for Nana is 3/4. 3 and addition of this 2, 3 plus 1, that is 4, minus old ratio for Nana is 5/10, total of this 3. Now you can see that the denominator of both the numbers is not the same. So we have to calculate the denominator, that is 40. 4 into 10 is 40. But here to this 4 we have to multiply by 10 to get 40. So both these numbers will be multiplied by 10. So 3 into 10 is 30 and 4 into 10 is 40. Now for 10 we have to multiply by 4 to get 40. So 5 into 4 is 20 and 10 into 4 is 40. Now our denominator is equal, so we can minus these numbers. So 30 minus 20 is 10/40. That is the gain ratio for Nana. In the same manner we have to calculate gain ratio for Nani. Her new ratio is 1/4, that is the total of these two. So 1/4 minus old ratio is 2/10, the total of these three numbers. So 2/10. Here also the denominator is not equal. So we have to make the denominator equal, then only we can do the subtraction. So this 4 we have to multiply by 10 and this 1 also we have to multiply by 10. So 1 into 10 is 10 and 4 into 10 is 40. Now here 10 is given, so to get 40 we have to multiply 10 by 4. So 10 into 4 is 40 and 2 into 4 is 8. So 10 minus 8 is equal to 2 upon 40 is the gain ratio for Nani. So the gain ratio for Nana and Nani is 10 is to 2, that is simplified as 5 is to 1. 2 5s are 10. So 5 is to 1 is the gain ratio. So the goodwill, the share of goodwill for Sona is divided into the ratio of 5 is to 1 and it is recorded on the debit side of the partner's capital account. So in continuing partners columns, the amount of goodwill which is written off is recorded as 3600. It means 3600 is divided into the gain ratio. You all know how to do the division, that is 3600 upon 6, total of this 2, into 5. Then you will get 3000, that is Nana's share. Then 3600 upon 6, the total of this 2, into 1 for Nani, so that is 600. Now we are going to check other adjustments. Adjustment number 5. What is given here? The entire capital of the new firm be fixed at rupees 1,60,000 between Nana and Nani in their new profit sharing ratio, which is fixed at 3:1, making adjustment in cash. Students, whenever the new capital is given, at that time the balance carried down will be recorded as per this new amount of capital, and it is to be divided into the new profit sharing ratio. So remember, whenever the capital is given in the question, that is the new capital. Whenever the new capital for the continuing partners is given in the question, you need to divide that capital in the ratio given, and then you have to pass the entry on the debit side of the partner's capital account as to balance carried down. So 1,60,000 is divided into 3:1 among both the partners. So remember, here balance carried down will not be the balancing figure. This figure or this amount is already given in the question. So in this case, the balance carried down will be cash. So here, as it is given in the question, that amount payable to Sona in cash and amount of adjustment should be done in cash for the continuing partners. So that is why the balancing figure will be cash. So accordingly, you have to read the question and you have to make the entries in the capital account. So after recording the entry of goodwill, then the entry of balance carried down on the debit side, then recording the entries of balance brought down, revaluation profit and goodwill on the credit side, we have to find out the balancing amount. Now for Nana, the debit side total is higher, that is 1,23,000. From that you have to subtract these two amounts, that is 50,000 and 4,920. So the balancing amount comes on the credit side, that is 68,080. So for that you have to write by cash account. Then in the same manner for Nani, the debit side total is 40,600. From that you have to subtract 20,000 and 1,968. So you get the balancing figure of 18,632. For that you have to write by cash. Now we have to find out the balance due to Sona. Here you can see that no entry is recorded except cash. So first we will take the total of the credit side, there are three amounts recorded on the credit side in Sona's column, that is her old capital, that is the capital at the beginning, then revaluation profit and the share of goodwill. So her total comes to 36,552. Since nothing is there on the debit side, this is the cash due to Sona. This cash will be paid to her at the time of the retirement. So this much cash goes out. While since the amount of capital is increased for the continuing partners, they have to pay this cash to the firm. Like Nana will pay 68,080 and Nani will pay 18,632. So this cash comes in the business. So that adjustment you have to do now while making the new balance sheet. Here the new balance sheet they have made. So under liabilities, creditors and bills payable will remain the same as it is given in the question, that is 10,000 and 5,000, because no adjustment is given for them. So they will remain the same, these two amounts. Then capital now only for Nana and Nani, that is 1,20,000 and 40,000. These amounts we have taken from here to balance carried down, closing balance in the partners capital account. That is the new capital now for the continuing partners. Then we are going to make the adjustments on the asset side. Now adjustment for cash. Now first we have to see how much cash was available as per the old balance sheet. They had the cash of rupees 17,000 as per the old balance sheet. In that we have to add cash paid by Nana and Nani, that is 68,080 plus 18,632. These two amounts will be added in 17,000. And then Sona is retiring, so the cash paid to her is 36,552, that is to be subtracted. So first 17,000, the cash given in the old balance sheet 17,000 plus 68,080 plus 18,632. We have to take the total of these three amounts. From that you have to subtract 36,552. So the remaining cash will be 67,160. Now the adjustment in the stock. Stock as per the old balance sheet is rupees 12,000. But then as per the adjustment number 1, the value of stock has decreased by 8%. So that you have to subtract. 8% of 12,000 is 960. So that is to be subtracted, less reduction. The remaining amount is written in the outer column. Same thing for the debtors. The amount of debtors given as per the old balance sheet is 12,000. But then RDD is to be maintained at 10% on debtors. So 12,000 minus 1,200. So outer column 10,800. Then as per the adjustment number 3, value of building has increased by 20%. The value of building is given 55,000. So that you have to write in the inner column, plus appreciation 11,000. So outer column 66,000. As per the adjustment, there was nothing said or nothing is given about machinery. So the value of machinery will remain the same, that is 20,000. So here 20,000 is recorded. Then you have to check the total of liability and asset side. It should be equal.